a full-service design build firm and consulting firm that's been around for over 120 years. But please continue to enjoy your lunch. We're going to kick off the program with the Federal Reserve Bank of Cleveland President and CEO, Beth Hammack, who will be providing an update from the Federal Reserve. Beth Hammack is the President and Chief Executive Officer of the Federal Reserve Bank of Cleveland, one of 12 reserve banks in the Federal Reserve System. She began her term on August 21st, 2024. In this capacity, she participates in the formulation of U.S. monetary policy and oversees 1,100 employees in the bank's Cleveland, Cincinnati, and Pittsburgh offices who conduct economic research, supervise banking institutions, and provide payment services to commercial banks in the U.S. government. Please join me in welcoming Beth Hammack to the stage.
Okay, thank you, Cody, and my thanks so much to the Ohio Bankers League for the invitation to speak with you today. Being in this room is a big deal to me. You might think of yourselves as unassuming bankers, but let me tell you why I think you're superstars. Not long ago, on a beautiful fall day, I was walking along Main Street with a local banker who I think is here, in Worcester, Ohio. Everyone knew him, lit up when they saw him, and shared stories about how he'd helped them with their business loans, with their mortgages, with their personal finances. It was like being in the presence of a celebrity, LeBron James or Donovan Mitchell. Everybody was shaking hands, greeting fans. It was really an awesome sight. And so while the usual Fed disclaimer applies, I know how important all of you are to the communities that you serve. In fact, I've understood the value of American banks for a long time. Before becoming a Federal Reserve policymaker, I worked in financial markets as a market maker and for an eventful period as a corporate treasurer. Like probably all of you, I vividly remember the beginning of the pandemic in 2020. As consumer spending fell rapidly across the globe, markets buckled, and firms drew down on their lines of credit, creating a severe cash shortfall. I worked firsthand under these challenging circumstances to make credit and resource allocation decisions. Fortunately, banks were in a good position to serve as a bridge between the financial system and the real economy. Community banks in particular punched above their weight. They made nearly half of the Paycheck Protection Program loans that were extended during the first 6 months of the pandemic. This support, along with fiscal actions and the Fed's emergency measures, allowed the economy to get back on its feet relatively quickly. 5 years on, that experience continues to reinforce that banks are a crucial source of strength for the economy. And I'll take that a step further. In good times and bad, the diverse U.S. banking system is our economy's secret sauce. And like any great recipe, our banking sector blends a variety of ingredients to create a flavor profile with balance and harmony, and one which is uniquely American. Strong banks are not only important for the economy, they're also essential for the effective implementation of monetary policy. Banks must be safe and sound in order to propagate monetary policy decisions throughout the economy. Tailoring regulation is one way we can ensure that the banking system endures as a lasting source of economic strength. At the same time, we should be mindful that loosening the rules too much could result in less resilient banks that don't serve the country well in times of stress. Just as we balance safety with economic growth in the supervisory arena, the Federal Reserve policymakers also have to balance both sides of our dual mandate for price stability and maximum employment. So this will be a speech in two parts: banking and monetary policy. I said before that our banking system is uniquely American, and here's what I mean by that. First, we have more than 4,000 commercial banks and thrifts in the U.S., offering depositors, investors, and borrowers a broad range of choices. No other developed country has close to the number of banks and thrifts that we have. Second, the banking system is diffuse, limiting the concentration of financial power in New York or Washington. We have both state and federal charters in the U.S., which affords banks the opportunity to select their regulatory framework, tap local or national capital supplies as needed, and provide more pathways for new banks to enter the market. The U.S. banking sector, like Ohio's, has three main segments. The Buckeye State is home to a number of GSIB branches, some regional banks, including 3 of the country's largest, sometimes called super regionals, and many smaller entities, 150 community banks and thrifts, and 34 mutuals. Together, this mix of financial institutions makes the economy more resilient, breeds innovation, and offers a wealth of options to consumers and businesses. Consider what flavor community banks bring to the sauce. Community banks excel at relationship lending, mainly to small businesses and in their local commercial real estate sector. This might sound like a niche, but supporting small business growth is immensely important to the health of the overall economy. While large public companies get the most attention, small businesses with fewer than 500 employees are their own force. In 2022, there were more than 6 million small businesses in the US. That's more than 99% of the total number of firms in our economy, and they accounted for a little under half of all payroll employment. In my conversations with small business owners, I often hear how they rely on community banks that know and understand them. During that visit to Worcester that I mentioned, a bridal shop owner told me that her thriving business wouldn't have been able to open without a loan from a community bank. This tracks with the Fed's results from our Small Business Credit Survey, which is managed by the ClevelandFed. In the most recent report, small firms that applied for financing at community banks were more likely to be fully approved than firms that applied at large banks. It's perhaps no surprise, then, that small businesses consistently rate their interactions with community banks higher than with the largest banks. Now, if community banks stand out for relationship lending, while GSIBs cater to the largest corporate customers, what kind of flavor do regional banks bring to the sauce? Despite the significant outflows of uninsured deposits that we saw during the spring of 2023, regional banks overall are faring well. Within the regional banking segment, there are many different business models. Regional banks make loans to small and middle market firms that may be too large for community banks, but are likely unprofitable for the GSIBs. Here they blend community bank style relationship lending with their larger balance sheets to make impactful investments. I heard a great example of this from an owner of a hotel chain in Cincinnati. He'd originally financed the construction of a new high-end hotel through a family office. But as interest rates started rising, he turned to the regional bank that he'd had a relationship with for 20 years to refinance the debt at a lower rate. Today, this hotel is making a positive local economic impact, thanks in part to the more favorable terms that the regional bank was able to arrange. Finally, regional banks are high-profile backers of the communities that they serve. You can see this in their Community Reinvestment Act projects and in the logos that adorn everything from Little League ball fields to professional sports arenas. And overall, they're doing good business. Their ROAs are higher on average than for the largest firms. So our sauce is simmering along nicely, with each banking segment bringing its own distinct and complementary flavor. Community banks add a dash of local knowledge and personalized service. Regional banks introduce depth, and the very largest banks provide national and international service at scale. But as any good cook will tell you, monitoring the sauce is required to keep things from burning. This is where bank supervision can exert an important and positive influence in maintaining the sauce's flavor and consistency. Bank supervision is one of 5 main responsibilities of the Federal Reserve, the others being financial stability, running the payment system, consumer protection and community development, and of course, monetary policy. Just as community and regional bankers know their clients, the Federal Reserve's team of examiners know their banking institutions. Under the Fed's decentralized central bank structure, examiners live and work in the same communities as the institutions they supervise. The Cleveland Fed represents the 4th Federal Reserve District, which comprises all of Ohio and parts of Pennsylvania, Kentucky, and West Virginia. Every day, our supervisors are on the ground to ensure bank safety and soundness. These relationships are long-lasting. Supervisors develop a deep understanding of their institution's strategies and thus can tailor their oversight to match the risks each bank faces. There is no one-size-all formula for supervision. Through these relationships, the Fed is monitoring the risks and challenges facing the banking industry with a particular eye on financial stability. The big risks are well known. Non-bank financial institutions are growing at double the pace of the banking sector, offering many of the same services without the same regulatory oversight. These services include private credit, whose speed, flexibility, limited disclosure, and customization often making it an appealing alternative to traditional bank loans. In light of this growth, it's worth considering whether overly stringent rules in the wake of the GFC move too much financial activity out of the banking sector. As I noted earlier, it's important to balance the benefits from safety and soundness with overall economic growth. Stablecoins are another relatively new development. There are interesting cross-border applications for this new technology, though their use as a domestic payments instrument is unproven. And the potential competition that stablecoins may eventually pose to bank deposits bears watching. Operational risks are always top of mind, increasingly in the form of fraud. And not just because of the ever-evolving cyber threat landscape. Practically every conversation I have with a community banker these days features an anecdote about the rise of old-school fraud. We're talking about people taking checks from a mailbox, washing them, altering them, and then putting them into the system. Social engineering scams that rob customers of their savings have also escalated, and banks are often caught in the middle. This adds another costly layer to banks' risk management activities. A less well-known, but no less serious challenge to the banking sector is the lack of new traditional entrants. Before the GFC, new commercial banks opened at an average pace of more than 100 banks per year. But since then, de novo entry has collapsed to roughly 7 new banks per year. While there are multiple factors behind this decline, a significant one is the increase in fixed compliance costs. In response to the decline in entry, bank regulators are presently working on easing application standards and speeding up the process for startup banks. Done properly, this is a sensible and welcome effort that holds the promise of increasing competition while keeping the pool of community banks strong. It's also consistent with a tailored approach to bank regulation and supervision, with the largest institutions subject to the most stringent rules based on the risk that they pose to the wider financial system. In sum, when it comes to regulatory oversight, balancing costs and benefits should be our guiding principle. It's appropriate to ease rules that have unnecessarily curtailed de novo entry, but it's also worth taking stock of the economic gains we reap from rules that have made the banking system more resilient. We rebounded quickly from the pandemic recession in large part because well-capitalized banks were positioned to continue lending to businesses and households when they needed it the most. Let's not water down the sauce to the point that the banking system can't support the U.S. economy as strongly as it does today. A healthy banking system is also critical to effective monetary policy. Banks, through their lending, help transmit Federal Reserve policy changes to businesses and households. So let me transition to my outlook for the economy. The past year has been a challenging one for monetary policy. Both sides of the Fed's dual mandate have been under pressure as the labor market softened and inflation stayed elevated. That's a tough mix because higher rates of both unemployment and inflation hurt everyday Americans. The good news is that the outlook is brightening. Recent readings on economic growth have been encouraging, and the labor market appears to have stabilized. Many forecasts, including my own, call for some easing in inflation over the course of this year. At this point, I believe monetary policy is in a good place to stay on hold as we assess the incoming data and weigh if and how policy may need to adjust further. Last year started on the weak side with meaningful uncertainty, but the economy picked up speed in the second and third quarters. Toward the end of 2025, the federal government shutdown likely slowed growth while disrupting the release of some key economic indicators. Consumer spending, the primary engine of the U.S. economy, held up well all year long. Though spending in aggregate has been resilient, it hasn't been uniform. For example, a visitors bureau in our district said that the gap between bookings at luxury hotels and budget chains has widened. This is consistent with reports from a range of businesses and community contacts that there's strength among higher income consumers and more cautious spending by lower income consumers, what some are referring to as the K-shaped economy. In the labor market, growth slowed and unemployment ticked up over the course of last year. Both official data and what we're hearing from businesses point to a low hire, low fire environment where companies aren't adding many workers, but they're not laying off a lot either. and workers are staying put more than usual. While slowing job growth and rising unemployment often signal bigger troubles ahead, recent signs point to stabilizing conditions. In December, the unemployment rate stood at 4.4%, similar to where it was in September. While not as low as it had been earlier in the year, it's close to what I and many economists think of as a long-run equilibrium. Initial claims for unemployment insurance have stayed low. Companies' warn notices of mass layoffs, which we track closely at the ClevelandFed, were about in line with their historic average through December, although some large companies have recently announced job reductions. Labor demand eased last year, but labor supply has also been limited by the aging population and reduced immigration. Overall, the labor market appears roughly balanced. Turning to the other side of the Fed's dual mandate, inflation is still too high. Our goal is 2% PCE inflation over the longer run. The latest reading was 2.8% last November. That's much better than in 2022, when headline PCE topped 7%, but inflation has largely moved sideways for 2 years. We feel the costs of elevated inflation with every shopping trip. The longer that inflation remains at these levels, the greater the risk that it becomes entrenched in the economy. One notable development over the last year has been the rise in goods inflation, especially for items that are more exposed to global trade. Businesses in the 4th District say increases in tariff rates have pushed up costs. While some firms have already passed along these costs, others say that more price increases are coming. A Northwest Ohio-based maker of farming equipment told us that they're starting to see the full effect of tariffs hitting their bottom line, and it's only now that they're getting ready to raise prices for their own customers. Now, tariffs are top of mind for many businesses, but they're not the only source of inflationary pressure. Rising prices for health insurance and electricity are also pushing up costs. At this point, it's too soon to say if these broad cost pressures have peaked. Looking ahead, I'm cautiously optimistic. Growth this year should get a boost from easier financial conditions, recent interest rate reductions, and fiscal support, amongst other factors. Businesses tell us that they're expecting some firming in activity, and bankers in our district say projects that were on hold last year are starting to move forward. Brighter growth prospects should translate into stronger demand in the labor market, helping to reduce the unemployment rate over the course of this year. Inflationary pressures should start to ease as tariff rates stabilize. Of course, there are no guarantees when it comes to forecasts, and there are considerable uncertainties around mine. Ultimately, I want to see evidence that inflation is indeed coming down. There's a risk that inflation could persist near 3% through this year, as it has for the past 2 years. Or inflation expectations could show signs of becoming unanchored if the public sees the elevated readings of the last 5 years as a sign that policy is not committed to achieving our 2% goal. On the other side, stabilization in the labor market could give way to additional softening if economic growth disappoints. 2 weeks ago, the FOMC kept the target range for the federal funds rate steady at 3.5% to 3.75%, a decision I voted to support. I believe we are in a good position to keep the funds rate at this level and see how things play out. By many estimates, including my own, the funds rate is now in the vicinity of neutral, meaning it's not meaningfully restraining the economy. If we see progress on both sides of our mandate, that tells me that policy is already at the right setting and that we should hold it there. Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time. To me, a steady funds rate would reflect positive economic developments, though holding rates near neutral might slow the return of inflation all the way down to 2%. If my forecast doesn't materialize, then policy would need to respond accordingly. Right now, I see the risks of a higher or a lower path for the funds rate as about balanced. History shows that flexibility has benefits. Setting policy to support a long economic expansion helps us to achieve the maximum in our maximum employment mandate. Long expansions provide broad benefits to American workers, but inflation needs to be low and stable to ensure that workers can fully enjoy those strong labor market conditions. I'll be keeping an open mind about the best policy path to achieve and sustain those outcomes. The long expansion of the 90s saw a series of decreases and increases in the funds rate in response to incoming data and risks to the economic outlook. During the long 2010s expansion, the Fed held the funds rate steady for an extended period. Just as tailoring supervision has benefits for banks of different sizes, monetary policy needs to be tailored to the conditions appropriate for each business cycle. During those lengthy expansions, both of which had low inflation, monetary policy operated independently from short-term political influence. That's very different from the 1970s, when political pressure on US monetary policy was stronger, inflation was much higher, and expansions were shorter. International evidence shows that countries with less independent central banks usually face higher inflation. This is because reducing inflation often entails tough trade-offs of short-term economic weakness in exchange for a future with lower inflation and stronger growth. In the US, former Fed Chair Paul Volcker took the unpopular step of sharply raising interest rates, which created a painful recession but finally tamed the high inflation of the 1970s. Then, as now, the Fed's independence goes hand in hand with its accountability to Congress and the American people. The Fed chair regularly testifies before Congress and holds press conferences after every FOMC meeting. We strive to be transparent about our decisions and the framework we base them on so the public can anticipate our actions. My colleagues and I on the FOMC frequently share our perspectives on how the economy is performing relative to our goals in media interviews, town hall meetings, and speeches at conferences like this one today. So to draw a parallel to the secret sauce of the US banking system from earlier, let me conclude with the key ingredients of the Federal Reserve's time-tested design. It's independent yet accountable so that policymakers can focus squarely on achieving the dual mandate. It's decentralized to ensure unique regional perspectives are considered in national monetary policy decisions. And it's structured to keep the banking system safe and strong by balancing regulatory oversight by the Board of Governors in Washington, D.C., with relationship-driven supervision by the regional reserve banks across the country. I'm proud to be a part of this institution, one that supports our unique banking sector, and I'm committed to achieving our maximum employment and price stability objectives on behalf of the American public. Thank you.
Thank you, Beth. I think we're going to have a couple microphones positioned in the ballroom here so that people hopefully will feel welcome to ask a question or two. I'll go ahead and get the conversation rolling, but certainly if anyone has a question on their mind, feel free to bring it up. First, thank you, Beth. Great to see you in person here today. We are grateful for you to spend the time with us and the emphasis that you said in your remarks as far as placing on the important role that each and every person in this room serves. So thank you for acknowledging that. Absolutely agree. And personally, as an economist, thank you for the stance you're taking on independence and certainly the importance of that dual mandate. So thank you.
Well, it's an honor to be here. As I said, I grew up as a banker, and so it's great to be back in a room full of superstars and people who really are supporting their communities.
If you would, maybe to start light here, talk a little bit about your move to Ohio and what maybe, if anything's kind of surprised you about living in Ohio, or just anything you're particularly impressed about beyond what you already shared.
Well, we'd spent a fair amount of time, my husband and I, in Ohio because he grew up in Northeast Ohio. So his parents are still there, his sister's there. So it's been great. It's a very different pace of life than New York City coming from there, but it's been really wonderful. We've enjoyed getting to know the region, and for me, one of the most fun parts of the job, one of the most interesting parts of the job is really traveling around the district and getting the full flavor, because what we have in the 4th District is really a microcosm of the country's economy. We've got representation from the agricultural sector, we've got a strong banking sector, we've got technological innovation that's happening, we've got energy production, we've got a lot of manufacturing going on, you've got eds and meds in full force. And so you really have a good representation of what goes on across the country here within the region. One of the things that I've found most rewarding is really the partnerships between the private sector and the community organizations. They really do come together in a really strong way, not just in Columbus, but all across the region to help support their local communities. And I have to say, for me, it's wonderful to be in a city where people are really proud of their city. In New York, people love to dunk on New York, but in Cleveland, people are incredibly proud of Cleveland, and it's nice to be a part of that.
Awesome, thank you. Appreciate you acknowledging all that. And also, I'd be remiss in not thanking you for serving the country in the important role that you are in. It's great to know that you get it as a banker, and just had a great career on our side of the ledger, if you will. And thanks for serving the country now as the Cleveland Fed.
Well, it's an honor and a privilege to be able to do this.
I'll hand it off to Brandon here first. Brendan, sorry.
It's Mike. President Hammack, thanks for being here today. I'm curious to know what you think some of the main financial stability risks are that you're seeing out there. Thank you.
Yeah, financial stability is one of our 5 functions, and it's something that I spend a lot of time and my staff spends a lot of time looking at and thinking about where could the next risk come from. I'll call out a couple of things that I'm paying attention to, some of which I mentioned in the speech. The growth in private credit is one, not because I think that private credit is inherently bad or particularly risky, but it's just very opaque. We don't have great visibility as to what's going on in those areas, and it's been growing very rapidly. Anytime something is growing and happening outside the banking system where we have less visibility, it's important for us to continue to monitor it as best we can, and so that's one. The other is stablecoins. It's an exciting new technology. I think it's certainly unproven as a payments technology, but we're open-minded about it. But how that will interact with the banking system, what that will mean for deposits, what that will mean for credit formation, certainly is something that we're spending a lot of time on. I think the most interesting use cases would be for foreigners who want to hold dollars that have a harder time opening up bank accounts, or for cross-border payments. Both of those I think are really exciting. But we'll see whether that's going to be their main use case or whether they are challenging to deposits, which obviously would be something more concerning to us. And then the last place I'll point to, which I didn't mention in the speech, is just the growth in leverage in the system right now. The amount of debt outstanding that Treasury has issued is quite significant. I think everyone would agree, and the chair has said numerous times, that the US government is on an unsustainable fiscal path. But to finance all that debt, a number of hedge funds have increased the leverage that they take it on quite significantly. And so that's a place, when we look at prior episodes where there's been instability in financial markets, a lot of times it comes from that buildup of leverage. And so that's a place that I'm continuing to watch closely.
And just to go a little deeper, if we can, on stablecoins, certainly that has been something the OBL has been very involved in, and we absolutely have concerns with the use case of it as a store of value. That certainly opens up the door to significant risk for our institutions in terms of that disintermediation. That money won't be working in the Worcesters and every other community across the state and across the country. However, that use case as a means of payment, another rail, if you will, that certainly could make sense. Yeah.
Yeah.
Fred.
President Hammack, thank you again for joining us today. You mentioned in your speech Fed independence. Could you elaborate a little bit more as to why an independent central bank is critical to the economy and in the financial system?
Yeah, thank you for asking that. It's something that we're spending a lot of time talking about these days. And it is really critically important. If you look around the globe, countries that have more independent central banks deliver better outcomes for their population, lower inflation, which tends to be the mandate of most central banks. We, of course, balance that with our maximum employment side of our mandate. But it's really being able to have an independent central bank allows you to deliver on that low inflation over time. And what's important is that we're independent yet accountable. Right? We're not independent because we want to go off and think in a vacuum. We want to talk to the public about what we're doing. We want everyone to understand our goals and our motivations and to help hold us accountable to those 2 goals that we've set out and making sure that we're delivering on it. And so the chair goes and testifies in front of Congress twice a year to explain how we're operating, what we're thinking about, what some of the key risks and outlooks are. And then I'm out with my colleagues talking frequently to share our perspectives on what's going on. It's really important that we're able to maintain that independence so that we can make those tough trade-offs if they should materialize. Because sometimes it means you have to have short-term pain for longer-term benefits of that low inflation over time. And so that's why the independence is really important for us. Thank you.
Agreed. Now I'll just reiterate it again, just how important that independence is from the OBL perspective. We're hearing that from bankers probably every day of the week as far as wanting the association, just to be very clear on that.
Yeah.
So thank you.
And I'd say, to me what independence really means is that when I walk into the monetary policy room, that I'm squarely focused on the data and I'm focused on the experiences and the anecdotes that I hear from people in the region when I'm out and about. And if I'm focused on those two things, that to me says that we have an independent central bank that's making the right decisions for the right reasons.
Great, thank you. Jason?
Good afternoon, President Hammack. Thank you very much for your comments today. My name is Jason Painley. I'm with McCannis Bank, headquartered in Mansfield, Ohio. I understand that the Federal Reserve System is undergoing a discount window modernization effort, that there might have been a request for comments or industry feedback out there. Was wondering if there's any meaningful feedback that you're receiving from the industry and if you can provide any comments on the direction of that project.
Yeah, thank you very much for asking. This has been an important project that started even before I joined the system. We did put out this request for comment in 2024 and got a variety of really good feedback. We in Cleveland have hosted a couple of roundtables to get more one-on-one feedback from bankers around what's working, what's not working. I think coming out of 2023, we all recognize that maybe not everyone in the system was prepared and ready to use a discount window, which is really an essential tool to help banks continue if they need to use it, if they need to borrow from that forum. And so making sure that banks were prepared, that they knew what it took. Now, I would say of the banking institutions that we engage with, probably only about half of them are set up to be discount window ready. From a lot of the smaller institutions that we talk to, it doesn't make economic sense for them, and that's a perfectly fine choice. We just want that if people are using it, are thinking about it, that they're ready and they know how to take advantage of it. Now, it may only be 50% of the institutions, but it's more than 90% of the assets within the 4th District are actually eligible to access the discount window. So that's a real positive. A couple of things that we're focused on is making it easier for banks to use. So that means technological change. I will admit that when I was a banker, I actually used the discount window. We would have to test it operationally. And it was a very cumbersome process involving phone calls and fax machines and things that you would think in 2026 are not things that we're talking about anymore. We've made some good progress from them in terms of modernizing, but there's still more that we can do. And then the last piece that we're really focused on is creating interoperability with the home loan bank system. We know that that's an important funding tool for a number of banks, and that being able to move your collateral between the two systems is incredibly cumbersome. They have 11 banks, we have 12. We have different headquarters, different geographies. We don't line up very well. And so finding a way that we can work together to provide that ease of use to the system, I think would be an overall benefit. So that's something we're continuing to spend time on. Thank you.
If we could, Beth, let's talk a little bit more about the discount window, the stigma, right? And you coming from the banking industry and your knowledge of working with the discount window as a banker, what is it that maybe needs to be done, we can do, because we hear there just is that stigma from an investment bank standpoint with a bank that is set up, tests the lines in that.
Yeah, it's very tricky. I mean, there is some things that we have done to try to minimize some of the stigma and some of the awareness. Now, of course, it's a congressional rule that we have to release on a 2-year lag, everyone who borrows and the name of the institutions. But we did change some of what we report in our Fed H41 so that you can no longer see reserve by reserve bank where the actual loans are happening at this point in time. So we've tried to aggregate that, which at least in real time, hopefully gives some more confidence to individuals. And this is really, I think, a conversation for bankers to have with their management and board leadership and talk about this is an essential tool as lender of last resort that we need to have available for banks. If you have a moment when you can't access funding markets, maybe there's a shortfall, it doesn't have to be the last resort, but it may just be time of day or the need that arises. And that's what we're meant to be. We're meant to be there to be that bridge between your short-term urgent needs and the longer-term financing plans that you may create.
Good, thank you. And thanks for what you have done so far to update the process, to make it quicker, more responsive and use of technology. I think I'd heard a couple years ago about mailing in packets and things like that, so it seemed a bit arduous.
We still sometimes do wet ink signatures on loans because loans are a little antiquated, so if we can digitize the loan space, that I think would help everybody, but that may be beyond our scope of the project. But there's a huge team at the Fed who's working on this, focused on making sure we can bring the latest in technology to make this as easy to use as possible. So we do really welcome all of your feedback and comments. Please keep them coming because it helps us to deliver what you need in this critical tool.
Thank you. And before handing it to Erica, I will just say thank you for really valuing that input. We take you very seriously on that, as far as the other prudential regulators as well. And I'll just give a shout out to all the bankers in the room here who give us that critical feedback from that firsthand perspective for our different comment letters. So please keep it coming so that we're effectively advocating for you. Eric?
I echo the other comments about the appreciation of you being here, so thank you very much and welcome. Eric Milstrup from LCNB National Bank down in Lebanon, Ohio. Non-bank entities, you talked about them and the rise of them offering similar services but aren't necessarily regulated ourselves. Would love your comments on, do you bring them in, should you bring them in or not bring them in to get similarly regulated?
That's a decision really for the Board of Governors in Washington. So as I said, the Board of Governors in Washington sets regulatory policy, and we at the banks implement the supervision. And so there's kind of this marriage between the two. I do think there's been a lot of focus on this growth in terms of the lending that's happening from these non-bank financials to understand what's happening. Over many years, there's been reform in places like money market funds to make those safer, more stable, less prone to runs. There's some good news when you look at the growth that you've seen in private credit, which is that by and large, those funds tend to be longer dated maturities and you don't have a lot of redemption rights. Now, that may be changing as some of those funds are becoming more public, maybe listed, and so there could be redemptions there, which is something that'll need to be studied. I know that, setting that regulatory viewpoint is really something that the Board of Governors in Washington is focused on, and looking at how do we make sure we have that right balance between safety and soundness and growth, because you could have a system that is perfectly safe, but no loans are ever created, and that's not where we want to be either. And so it's really getting that balance right, and I think that's something that will just change over time. And I think it's something that needs to change over time to adapt to how the economy is performing, where the needs are coming out.
I'd like to talk a little bit more about supervision. I'm looking at Annalika here. I want to give her a shout out. I absolutely appreciate everything that she does and the access she gives us to weigh in so we can give feedback that we're hearing from the bankers. Could you please just talk a little bit about that side of the house and any trends that you're seeing in the exams right now? Anything concerning you or some words of caution you want to put out there?
Yeah, I'd say right now the banking system looks pretty good. It looks pretty healthy. We're seeing capital ratios continue to trend upwards, which is a positive development, and it's been reasonably stable. When we look at loan growth is starting to pick up. I talked about some of the anecdotes from the bankers. Those projects that were on hold because of all the uncertainty in 2025 are starting to come back in and get financed and move forward, which is really healthy. Similarly, we're seeing delinquencies have been kind of tapering off. Again, that's a place where we're going to want to watch closely to see how it performs. But sectors like commercial real estate and office in particular is a focus that we've continued to monitor. But things, generally in the banking landscape are looking pretty good.
Good, thank you. Paul?
President Hammack, thank you again for being here. And thank you for the shout out that you gave at the podium to the 34 mutuals that exist in the state of Ohio, a charter that's very near and dear to our hearts.
It's footnoted in the speech, but I took it out of the line. It is the most of any other state other than Massachusetts.
Yes, that's right. Thank you. Thank you for acknowledging that. We all understand that movements on the short end of the curve don't always translate into parallel movements on the long end of the curve. I'm curious about what comments you might offer relative to mortgage rates and its impact on what has been a very challenging housing market.
Yeah, it's a great question. We do have one blunt instrument, which is the federal funds rate at the very short end of the curve. And so we use that to try to set policy and help spur investment when needed, or restrain investment when needed, to bring our dual mandate objectives. We don't control the mortgage rate. We don't control the 10-year rate. Those are freely traded market rates. And there's a lot of factors that go into what drive those rates. Some of it has to do with the amount of issuance that happens. Some of it has to do with expectations of inflation. If there's more expectation that inflation will continue over the longer term, that would typically mean higher interest rates and more risk premium put into the marketplace. And so we do monitor them because the financial conditions broadly are, when I think about what financial conditions mean, it's that short end rate, something like the 10-year rate or the mortgage rate, credit spreads, how the dollar is performing. All of those are factors that will spur businesses to make more or less investments in the marketplace and drive things. And so again, we have one very blunt instrument that we control, but we're monitoring those other ones. And I take some signal from the markets about how those are performing to give me some indication of, are we doing our job effectively or not? Right now, one of the things I'm spending a lot of time looking at is inflation expectations. Given that inflation has been above our target for so long, I do worry that it's going to be, that you could have a risk that it becomes entrenched in the psyche, and that individuals in the public don't believe that we're as committed to our 2% objective as I am committed. And so we're watching that inflation expectations closely to make sure that it's not showing signs of moving up. To date, it hasn't been. It's been relatively well contained. But that's a place that I need to continue to monitor to make sure that that stays with that lower 2%, in and around that 2% goal where we want it to be. Yeah.
If I could press you a little bit on that 2% goal, I'm thinking back to my days in college in the 80s, and full employment was like 6.5%,
Yeah.
and we've certainly blown through that. Is the 2% just an outdated figure? Why not 2.5 or 3?
The 2% target was arrived at in 2012. That's when the Fed first came up with that number. There are a lot of reasons why we came up with it. I mean, what I'd say is that you want an objective that is low and stable. You don't want to be at 0 or negative, because that usually means that your economy is not doing particularly well. So you want some amount of inflation. But you don't want it to be high. You don't want it to be a runaway type of number. And so there were a series of conversations that settled on 2%. I think it's critically important that we achieve that 2% goal before we talk about, would it be appropriate to change it? Different economic cycles, different environments could have a lower or higher natural rate of inflation, and that's something that we certainly should consider. But right now, I think it's critically important that we deliver against that objective that we've laid out before we talk about moving it.
Thank you. Michael?
It's kind of low. Thank you. President Hammack, thank you for coming and talking to us today, taking time out of your busy schedule. Mike Lewis, President and CEO of Hometown Bank in Kent, Ohio. I'd love to hear your thoughts on something new, AI, that's come to the market, and how it's going to affect the economy and how you think it's going to affect the workforce.
Yeah, I can't do a meeting without talking about AI. AI is everywhere all the time. It is an exciting new technology that offers a lot of potential. We're hearing from businesses that are adopting it. Certainly, I hear from businesses very small, like 1, 2, 3-person businesses, that are relying on it very heavily because they have to. They can't afford more employees, and it's providing a lot of leverage. I hear about it at the very large end of companies who are adopting it, but it can be expensive to really put into your culture and to make it a core tool that you're using. And so I hear in the middle that there's maybe less adoption, some experimentation. People are thinking about how can they try to use it, but I've seen less adoption there. Our researchers at the ClevelandFed are spending a lot of time looking at it. Right now, it's too soon to say what the impact is going to be. There are a lot of questions. Will it replace workers? Will it complement workers? Every time you look at some of these transformative new technologies, whether it's the steam engine, electricity, the internet, what you saw was that there was a whole series of jobs that went away, but there were a whole new series of jobs you couldn't even think of that were created. So I'll just give the example. This is not AI specific, but if you'd asked someone 20 years ago, 25 years ago, if you'd said that there was going to be a job called influencer that was going to pay money, you'd have been like, I don't understand, what is that? How could that possibly be? And so I'm sure that AI is going to have its own series of jobs it will create that we can't conceive of today, that will create new opportunities. So I'm optimistic that I think it's going to be another transformative tool, but we're monitoring it closely because I know there's a lot of fear that it could replace jobs. When I'm out talking with companies, and I was with 2 different companies this morning, hearing their perspective on how they're integrating AI, I hear that there are places where it is replacing workers, but I also hear about maybe an equal number of places where it's complementing workers. So a hospital system that I was speaking to has talked about how they're using AI to have their physicians spend more time with patients, less time charting, less time writing notes. And so they're not thinking they need fewer physicians, they're just thinking it'll be a better quality of care. They'll be able to provide better service to people. And so I think it'll be a balance between the two, but it's a place that we're watching closely to see how that could shift things.
Thank you, that's helpful. One last question, Tony?
Tony Davis, People's State Bank, New Lexington, Ohio. Thank you again for being here. I don't think we want to leave without a little further discussion about stablecoin. So what do you think the use cases might be and how it may affect the banking industry?
Yeah, I mean, to me, when I think about stablecoins, I kind of have a hard time in the domestic context of what the benefit of a stablecoin is. Because though we at the Federal Reserve are responsible for making sure that you have fit paper currency in your wallets, most people think of their money as digital. They think of it as an electronic entry in their bank account. And so I'm not sure what the difference between that electronic book entry is and a stablecoin for use in the domestic payment systems. You can send money a variety of ways. You can still write checks, but there's a lot of increasing electronic forms of moving payment. So we operate a real-time payment system called FedNow. I know there's a private side competitor. There are ACH opportunities. We run the FedWire. There are lots of ways to move your money right now. I think they're pretty, if not frictionless, they're pretty smooth and seamless. I think the best use cases that I've heard, the most compelling, are international or cross-border applications, because that is where we tend to hear of the most frictions, the most challenges in moving money, is between the US and some other jurisdiction. We also hear that there are foreigners who would love to be able to hold dollars, but opening US bank accounts is complicated. The KYC and AML rules are actually very stringent, and so it makes it difficult for them. Now, of course, there's money market funds and other bonds that they could buy through investment accounts, but stablecoins could be a way to provide a dollar-based asset to those types of players. I'm optimistic that because we have such excellent use cases or such excellent flowing of dollars within the US, that it's not going to be a competitor to the banking system or a competitor to deposits. But it's a place we need to watch very closely because deposits is the formation of credit and lending throughout our country. And so if we see deposits come down very significantly in favor of stable coins, where that money is being used more for either short-dated treasuries or potentially deposits itself, that could shift the way that credit is created within the country, and that's a place that we'll want to spend a lot of time looking at it.
Thank you on that. Any final words?
No, I would just say, look, thank you very much for having me here. It's an honor to be here. I'm really privileged to have this opportunity, and we really welcome all of your thoughts. So whether it's through our partners at the OBL or directly, we really love engaging with the community and hearing what's working for you, what's not working, and there's always things that are changing within the banking sector that it's great for us to stay apprised of. So please, keep your feedback and insights coming.
Absolutely, we will do that. So thank you for being here today. Thank you for the awesome team that you have up at the Cleveland Fed. And if everyone would please join me in thanking Cleveland Fed President Beth Hammack.
Thank you.
Thank you.
Thanks.
Appreciate it.
Yeah.